Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Before we get into this week's show, listeners, if you've been enjoying the Independent Advisors Podcast for a while now and want to take the next step in your financial journey, I'd encourage you to head to our website, jessupwealthmanagement.com. I offer a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at the jessupwealthmanagement.com website, just click Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today.
Welcome to episode 310 of the Independent Advisors Podcast. On today's show, we're covering a few timely and important topics, including an update to Q2 earnings season so far, how tariff headlines are affecting the markets, recent housing data, and what a change from the Fed chair would mean for the markets. Whether you're tuning in for market insights, planning tips, or just staying informed, there's something here for you. Let's jump in.
Alrighty, as always, we start by going through the pricing. This pricing is from Y charts as of yesterday's close. So as of 7/23/25, the S&P 500 is up month to date 2.5% and 8.1% year to date. The Dow Jones is up 2.1% month to date and 5.8% year to date. The Nasdaq is up 3.2% month to date, 8.9% year to date. The iShares Russell 2000 ETF, think small cap stocks, is up 5.0% month to date and 2.6% year to date. The Vanguard FTSE All World ex-US Index Fund is up 2.8% month to date and 20.4% year to date. The 3-month Treasury rate is sitting at 4.41. The 2-year Treasury rate is sitting at 3.88, and the 10-year is sitting at 4.4. Any comments before we jump into big headlines?
Yeah, I mean, Nick, if you went to sleep on January 1st and you woke up today and you saw some of these high single-digit rates of return on these equity indexes, you'd think, hey, this has been an easy year.
Yeah, you would. Yeah, we talk about that a lot.
I can't help myself from looking at that and immediately thinking that, right?
Indeed.
Oh my goodness. Well, we got a Fed meeting coming up on next Wednesday. The announcement's at 2:00, and I know you got more on that topic, so let's table it. But thinking of Treasury rates, I can't help myself with the Fed meeting knocking on the door right around the corner, right?
Yeah, the Fed meeting's coming up next week, and there's been a lot of headlines about the Fed, so we're going to talk about that in particular. But moving it along, generally speaking, Q2 earnings is we're right in the middle of it, right in the peak. It's really ramping up. Going to see a lot of big names reporting over the next couple of weeks. The vast majority of companies are exceeding consensus estimates, I would say. The reactions haven't always been positive. Mostly that's because of some deficiencies on the guidance side of things, which is pretty typical, especially when valuations and multiples are a little higher than historic averages. Overall, there hasn't been one report that's upended the market. Investors are still viewing everything very, very positively. As always, keep an eye out for the mega cap companies. They're coming down the pipeline. A few of them have already reported this week, so all good on that front. But again, we're still right in the middle of it.
First of all, if you don't love earnings season, you don't have a heartbeat. Okay, that's the first thing. Secondly, when the mega caps start reporting, remember what I said on the podcast several weeks ago. I think there's going to be the potential for some beats purely on the Forex, the currency exchange, because the dollar was so weak during the second quarter.
It's a good point. An excellent point for listeners.
I can't remember. I mean, I know it's happened, but the last time the dollar sank that much in a single quarter. It's been a long time. It's been a long time in a single quarter like that.
We've had dollar strength for years and years and years and years.
Well, I can tell you the C-suites of these mega caps are eating it up.
Yeah, absolutely. In other news, I'm sure listeners saw news about Japan and EU trade deals. The Japan deal is finalized. That features a 15% tariff rate on imports. Also, a investment of 550 billion into the U.S. and the opening of Japan's markets to rice and auto imports from the U.S. The fun part of this deal is that Trump gets to decide where the funds are invested, and Japan only gets 10% of the profits on said investments. That raises some eyebrows, but hey, the deal's done. So there was also
that's impressive. I don't care what side of the political aisle you're on. That's wow.
Yeah, when I
saw that, I was like, wow, that is
things you don't expect to read about global macroeconomics and trade deals is a deal like that.
Impressive.
But good nonetheless. I think generally for the economy, and the takeaway here is the rates that we're going to set in August 1st were 25%, so 15 is quite a bit lower than that. The market likes that. Japan's market certainly likes that. So I think all good news on the Japan front. On the EU side, there were some murmurings about some, kind of trade war stuff early in the week, but then yesterday around 12, the Financial Times reported that the U.S. and the EU were close to finalizing a trade agreement, also with that 15% tariff rate. So the market really likes hearing that as well. So on the tariff front right now, all good news.
I have a piece on this, Nick, in regards to market reactions on tariffs in a little bit. So I'm going to save some of my comments until that time.
Okay, excellent. And then lastly, on the big headlines and current events, economic data, the labor market and the consumers continues to be strong, but we are seeing some sluggishness in housing, which I know you talked some about last week. We're going to talk more about that in depth this week. On the 17th, we saw strong retail sales data up 0.6% in June, beat estimates, as well as initial jobless claims came in lower than expected, which is really kind of the same old story with the underlying economic data where the consumer's holding up well. And we're not seeing layoffs in massive numbers, which is one of the reasons why the Fed is still holding their interest rate policy, much to the chagrin of the president and others on Wall Street. But the jobs data, the underlying consumer data, the fundamental data continues to be strong.
All right, so I'm going to slice and dice that for about 60 seconds for our listeners and viewers.
Okay.
Strong retail sales data, up 0.6% for the month of June. Saying it directly, individuals that have been bearish over the past several months on the status of the American consumer, you're wrong.
Right.
I'll make it simple. And the million-dollar question is, what's the sustainability of that, right? What's the outlook? Are we going to have some tariff inflation on the back end that'll start to affect the spending capacity of the American consumer? But if you go back to the playbook that's been in place for the last 5 or 6 years, the market continues to discount the underlying strength of the American consumer, continues to surprise us, and we're like, wow, I can't believe that is that strong. Get out of here.
And at some point, we're gonna have to acknowledge that there might not be as much transitory inflation with the tariffs as we expect. That is something that might happen, where we get 3-4 months down the road and it's not as bad as we thought, and then the market continues going on. So just another piece of another
you said
thought
that
to
very,
think about.
very well, Nick. And I'll even take it one step further. Are you going to see it in certain areas? Yes. And so the people that are calling for this huge, inflation hit because of the tariffs, they're going to focus on that area that's like 20 to 30% that's causing it. And it's a big deal. And it goes to the whole thing. So far, it has been nowhere near the expectations or concerns that were out there in March and April. Do a Google News headline search for tariff concerns in that time period for what they were calling for now,
Yeah.
no one, not a lot of people, listen to the Independent Advisors podcast, we were talking about that, but a lot of people weren't calling for what you're seeing right now.
Yeah, 100%. The last little piece of economic data was from yesterday. Existing home sales data came up short of estimates, decreasing 2.7% in June. We have a lot more on this later. The key takeaway from the report is that median home sales prices continued growing in June, even though sales are decelerated.
That's a
So it
big
kind
data
of
point right there.
Yeah, it kind of puts a spotlight on housing affordability, particularly at a time when rates are high, so mortgage rates are high. And like I said, we'll get into that more later. So moving into to tweets, articles, and research, what do you have for us this week, Matt?
I'm going to start. Jenna reminded me on episode 295 of the Independent Advisors podcast. We're 3 months out from that. I had a piece. The timestamp on this, for those that want to go back and listen to it, was April 7th. I had a piece on the VIX, or the volatility index. And to break that down in about 30 seconds, it's an index that really looks at what is the expected volatility within the market. And there's it's based upon option premiums. I'll kind of leave it at that for a simplistic example. But the index has a long-term time horizon. And when that index spikes to 45 and goes up these really high levels, Nick, there tends to be some pretty consistent data how the market reacts. And I'll give you some examples in this data set. 1 week later, 2 weeks, 1 month, 2 months, 3 months, 6 in 12. Well, it's been 3 months. So Jenna reminded me of that. So in the data set, when I was on the podcast that week in early April, the 3-month average when this spike in volatility happened is the average return for the S&P 3 months later was 11.19%. Well, timestamp it from April 7th to July 7th, according to stock charts data set I ran this morning, that return came in at 22.78%. Why am I highlighting this? Doesn't mean every time that we go over the statistical lens when an event or a data set happens that when we give that, it's going to be positive or it's going to be around that number. But I also want to throw it out there when we do show the historical lens, what actually ended up happening?
Right.
Well, it was double-ish. Your thoughts and comments on that?
My thoughts and comments, just and for a lot of listeners out there, there's another line item in this data set that's called win rate. And the win rate 1 week later was 68%, 2 weeks 68%. And then continues on, but that 3-month level, and it continues on higher, I should say, as we go on in time, which you would expect with the historical averages of the market. That makes sense. The win rate goes up with the longer time after a big spike in volatility, which spike in volatility is typically correlated with a big drop in price, right? So the win rate at the 3-month level was 87%. So
you were within that 87%, right? Good point.
Pretty good stat there.
And then Mark had on that same podcast episode of 295, Mark was talking about a stat from Ryan Dietrich from Carson. It said, what happens after the S&P drops 10% in 2 days? So between 2 trading days in total, it drops 10% or more. And their data set was about half a dozen. And the 3-month average going back to 1950 was 6.6% with a win rate of 80%. And again, you saw the number above 20% return. So again, those are just data points, guidelines for how the market reacted when you had similar data underlying it, right? That's why we talk about it. And again, it's not bulletproof. It's not a silver bullet that's going to give you that exact outcome. It's a guideline.
Absolutely. Nothing is bulletproof.
Nothing is bulletproof. All right. So the first thing I'm going to cover here, I'll be curious to see the Nick Whitaker feedback on this one, is in case listeners and viewers, you didn't notice, healthcare stocks in general are out of favor. So there was a post, Nick, by Bar Charts, and the timestamp was July 21st. I do have a confession. I did my show notes an hour before the episode today, and it is like the closest I came right up to the line to do my notes. I'm not sure how nervous Jenna was about that. But what this piece shows, Nick, is that healthcare stocks saw their biggest weekly outflows in more than 5 years. So I know Jenna will put up this this chart for our YouTube viewers. This will be in our show notes for our traditional podcast listeners. But why am I highlighting this right now? Right? First of all, I want to kind of bring it to people's attention that even though stocks in general have moved higher recently, not all things are created equal. And let's talk about what some of the reasons that maybe healthcare compared to other sectors in the market could be out of favor. So first of all, healthcare is typically a sector that's seen as a defensive sector. And, seeing this type of outflow shows maybe a shift in institutional sentiment. Could it be a rotation into higher volatility or beta stocks? People trying to play catch up because they de-risked in March and April. Could it be the anticipation of continued policy and regulatory risks, Nick? Could it be fading growth expectations within the sector? Or more simply put, is it as simple as we're in a risk-on investment environment currently? Thoughts and comments?
My initial thought is that it's hard for a sector to perform well when one of the top dogs in the sector is getting crushed. So that's one thing to think about.
I like that. That's
just
a
from a
very
weighting,
excellent point.
From
That's
a
very
sheer
excellent point.
weighting perspective, and the top dog I'm talking about is UNH, and that's not a recommendation for or against UNH, just commentary that UNH has obviously been under some hard times being investigated by the DOJ.
For listeners and viewers.
Yeah, and so year to date, I just pulled it up. UNH is down 42%.
And for a mega cap name, that is just absolutely brutal.
Yeah, it's brutal. And so now the chart that you're showing, to be clear, is a 4-week. So I looked at the 4-week, and UNH is only underperforming the benchmark by 7 or so percent. The benchmark is the healthcare sector, right? So they're underperforming the healthcare sector. But anytime you have these really big weighted names in a subsector, sector, even the S&P 500, for example, when those are underperforming, it can really be tough for the sector to outperform, because obviously the weighting is higher, so it's just dragging the percentage down. So that's one thing I would think about. I think everything else you said is absolutely possible, and probably it's a mix of everything. Where, yeah, I think there's some policy risk on the tariff equation, particularly around pharma, with a lot of the headlines we've seen, and that's not been worked out yet. You have UNH and the DOJ. You have the opportunity to pick up some high beta right now, with where the market is, and pick up some small cap exposures. We've seen small caps kind of perk up a little bit recently, so that would be a sign that there's some interest in the risk side of things. So I think it's likely a combination of all of those things.
I love your side of it, though, on, hey, for the healthcare sector, the top dog is just getting taken behind the woodshed and just beaten bad. That's a good point. My next piece, this is my bearish data point of the week. So I know a lot of times in the podcast, I exhibit some optimism, right? It's because a lot of the data has been positive, contrary to some of the headlines. But this one's not. So this is a post by Michael Arway. Yeah, he is posted this on July 22nd, Nick. And the underlying source of the data is Vanguard and their 401k platform. And what it's showing is that, quote, more Americans are breaking into their 401ks to help make ends meet. And what it shows is that a percentage of Vanguard 401k participants using hardship withdrawals, and that has practically doubled over the past 5 years. I'll verbalize the data set because most of our listeners are on traditional podcast. I know the illustration will go up for our YouTube listeners. It typically hangs out in the what's called the 2% range per year. So 2% of all 401k participants that have a Vanguard as their platform take a hardship withdrawal, which I'll talk about how you qualify for that here in a second. And that number for last year in 2024 went up to 4.8%. So you've seen a big rise in these hardships. And here's the thing we got to realize. Qualifying for a hardship withdrawal is not easy, and it's designed that way on purpose. So the government, the IRS, develops the language in which one could qualify for a hardship. And it allows you to tap into your 401k if you're still actively employed. And some of the reasons could be very high medical expenses, the purchase of a first-time home, avoiding eviction or foreclosure on a house. Like, there's some really stringent requirements. You can't just be like, I want to buy a bass boat and I'm going to take a hardship from my 401k.
Yeah.
Right? So I just want to throw it out there that not everything is peachy keen on, let's call it the American consumer front. But we got to face reality. We got to follow where the money goes. And this might be the hot take now. I'm less concerned, if I have to throw it out there, about the balance sheet side of the decisions right now versus the spending side of the decisions. And that might not be a popular view, but the reality is, as investors, we need to dissect what is a today problem, what is a tomorrow problem. Thoughts and comments?
I agree that this is a sign. There are other signs out there that the underlying consumer is not as healthy as the hard data that we talked about at the beginning of the podcast would suggest. There's also a lot of research and data out there that discusses who's pushing consumer spending, and there's been a divergence of classes in the US for going on a while now, a couple decades really, where you see the middle class is not as big as it was 40 years ago. There's a section of the economy, particularly the US economy, that is pushing more towards consumer spending than they ever have. And it's kind of that really upper middle class level and just slightly above that. So maybe not like your millionaires and your billionaires, of course they're contributing, but just kind of right under that, people who are doing very well, very economically healthy and have very good jobs. And that's this section. And it's a smaller section of the economy than you might think, of the US economy, I should say. But that is a big piece of where the consumer spending is coming from over the past 5-10 years. So that's why you can see the big top line numbers that we as financial analysts and economists and market participants are looking at, because that at the end of the day, like if it keeps going up, hey, it's going up, right?
Yep.
But that's why you can also have these other data points like this, where you're saying, okay, well, how does that keep going up? But then you see it's clear that hardship withdrawals have doubled in the past. Sorry, let me get a timeline. In the past 4 years, they've doubled. Where's the dislocation? And that dislocation is basically there's the distribution of wealth is not equal, right? And so that's why those numbers can differentiate. So and I know that could be a sensitive topic, and I don't say that to be insensitive to anyone of any economic level. More just trying to help you think through some of these data points, if that makes sense.
You said it perfectly, Nick. Now, I have one other angle that's not really being talked about in the market today, but I think will be over the next 2 to 3 years. And what I'm about to say will be the action that American consumers will take to repair their balance sheet, which is the following. Ready for this? As interest rates come down the next couple of years, assuming that's the case, the average homeowner in the US has not tapped into these huge equity gains that they've seen in their home value since the pandemic. And they're going to be doing refinances. They're going to take cash out. They're going to retire debt. And the reason they're not doing it now is why in the heck would I refi when I have a sub fill in the blank, 4%, 4.5%, maybe even lower than that mortgage? I'm going to wait when rates come down. I'll refinance. I'll take an extra 50, 100,000 out. I'll retire some debt. I'll do the home renovations that I want or my spouse has been bugging me to do. And I think that's exactly how this is going to go the next 2 or 3 years. Bull market if you're a mortgage broker, in my opinion, the next couple of years. But when I look at that lens, no one's talking about that right now. But if you look at the lens of history, that's exactly the rinse and repeat scenario that you saw, especially in the 90s and the 2000s. Now, that didn't end well at the end of the 2000s because the underwriting requirements for those mortgages was Nick walking into the office saying, I am director of research and trading at XYZ firm and I make X. And they're like, great, Nick, sign right here.
Yeah. Yeah,
But you
that was
see
a
what I'm
whole
saying?
that
And
is a whole
that is
different
not,
basket of
that
cards.
narrative is not being talked about in the marketplace. No one's
Yeah,
touched these equity gains. You can sit there and say, my house is up 50% in the last 5 years. Good for you. That gains on paper.
that's a great point. That's a point that I had not even thought about. So that's a very good point.
All right, timestamp that, Jenna. July 24th, 2025, 9:32 a.m. I'm sure she's going to have fun splicing this down the road. So number 3, I have a piece. It's from Neil Setti. He posted a chart from Goldman on July 21st, Nick. Has to do with the reactions in the market. He's underlying is S&P 500. Reactions of stocks on tariff-related news. And what Goldman did is he cherry picked some pivotal headline days, Nick. I'm just going to name them: February 3rd, March 3rd, April 2nd, April 9th, July 7th, and July 13th. And what they did is they show kind of the average S&P 500. And then what they did is they have a proprietary bucket of stocks that are more tariff sensitive. It's specifically called the GS Tariff Risk Basket. Very technical there. Good job, Goldman, on getting a good name on that one. But what you're going to notice is that the reaction is becoming less and less to the market when these headlines hit. So here is where the rubber hits the road for me. Every time the market gets the same headline, it cares less and less about it. Yeah, at times, Nick, you got to treat the market like it's a child, okay? And when I initially tell my kids to do something, they tend to initially listen. But when I rinse and repeat it over and over again, they kind of become deaf to it.
Yeah,
Your
it
thoughts
turns
and
into a
comments.
suggestion.
Yeah, a guideline. Well, your thoughts when you see this data? I mean, I think you stare at your terminal all day long, even more than me. I mean, I know you see this, but
Yeah.
any other thoughts, comments? I mean, the data supports it.
Yeah, I chuckle looking at this because I'm just thinking internally the analysts who are putting this together, they're just trying to quantify the taco trade. Uh,
I love it.
that's all it is. That's literally, and
So for
for
newer
listeners who have
listeners,
not,
can you dissect that for what that means, the taco
there
trade?
was this is probably a month or so ago where with all these headlines back and forth, someone somewhere out there in the worldwide internet came up with taco, and the acronym is Trump always chickens out.
Classic.
And that kind of ran across the street. I mean, I saw it in financial news. I really only tune into to financial news and the markets. So if I'm seeing it, then it's it's really out there. And yeah, so I think that's exactly what it is they're just quantifying that because you did start to see the market change the behavior to headline announcements where Trump would say something or someone from the administration would say something and the market would just completely ignore it. And we saw that it was slow, but it eventually got to that. So that's what Goldman's doing here is just trying to show that on a chart.
Now, I'll throw this out there. As an investor, I'm okay with that, right?
I'm
You
okay
get a
with
little
it
bit
too.
of
Yeah.
predictability. And I think the
Yeah.
closer, taking out personal politics, the closer we get to the midterms, if we are starting to get a track record with how the administration is handling certain things, the market becomes a little more comfortable with that. And again, take
Yeah.
out personal politics. If
Right.
the behavior and the reactions of the administration start to become more stable or predictable, I'm not insinuating that they are perfect by any means. But it seems to the market, it's nowhere near the movements and the decisions that were being made in Q1. That's not a negative. And as I would normally say in the podcast, that's not bearish.
That's not bearish. That's right.
Back
That
to you,
is not
Nick.
bearish. Alrighty, so the first thing I have is just following up on existing home sales. So these are a couple of sources here, Bloomberg, Trading Economics. U.S. existing home sales fell to a 9-month low on record prices. So the June data, which we previously discussed, existing home sales, just to dissect that, just to make sure everybody knows what we're talking about, those are homes that have been previously owned that are selling,
Yes, sir.
which is a large majority of the homes out there, right?
Yes, sir.
Um, why are existing home sales falling? Record prices and high borrowing costs is the answer. The median sales price increased 2% in June from a year ago to $435,000. So that's the median home price in the US. Home prices continue to rise even after the pickup in recent inventory, which you may have heard us talk about over the past couple of months. We have had a pickup in inventory, which is typically good, can kind of balance out, I should say, typically good in this environment
Yep.
because prices were going so astronomically high over the past, let's call it 5 years. What I want to say to listeners is that this trend could continue for a while where you see existing home sales falling, but you're not seeing the prices falling. That trend could extend. I think it will take a lot of pain before you start seeing the prices falling, because even now, houses are still being bid over the asking price. Even
In the
now,
majority of the country, I would agree with that.
yeah, and there's stats on that. I don't have those in front of me, but I know that's still pretty common. So you're going to have to see that whole environment change to where then you're going to start bidding at the ask, and then you're going to go under, and then it takes a long time for the price of the housing market to move. It's not a small cap equity. Okay, it's not going to move quick. The other thing to consider with this trend is that mortgage rates are still hovering near 7%, and home prices, as we've talked about, are up about 50% since 5 years ago. So there's just a lot of there's a lot that's been going on and a lot built into the housing market and why it is the way it is. If you take that and then you add that piece that I mentioned earlier when we were talking about the high high middle class and just above that, kind of pushing consumer spending. Well, that's a big piece of what can be pushing the home sales as well, right?
Yeah.
So my part two on this is the median income needed to purchase a home. This is actually a research piece from Charlie Bilello. He has a research blog called The Weekend Charts, which I encourage you guys to go out and check out. It's great. And he says the median household income necessary to purchase the median priced home for sale in US is 123K, is now 56% higher than the current median household income of 79K. This is the most unaffordable housing market in history.
You
So
can
I'm going to say
blame
those
the
numbers.
you can blame the printing of the dollar last 5-6 years.
Exactly. I'm going to say those numbers again, just to make sure listeners understand it. So the current median household income is 79K, and the median household income necessary to purchase um, a, a a median household that home, which is that 435K, you
Yep.
would need 123K. And the quick math on that, they use 30%. You need 30% of your gross to buy a house is
Yep.
essentially how they're doing that math.
Yep.
And so that difference between that 79 and the 123 is your 56, and that's essentially like your affordability gap of like kind of where's the median of the household consumer and what do you actually need to buy the median sales price. And so that's the 56% affordability gap. And I don't think this will come as a shock to anybody.
Mm.
It's been going on for a long time, and like I said, the past 5 years really, and that was COVID and just injecting a ton of cash into the economy, and then from there, home sales just skyrocketed. I lived through that, buying and selling, buying and selling a home, and then buying another one in that 5 year period. So yeah, it's very tough. And like I just said, I don't expect this to just crash off a cliff anytime soon.
No,
I don't
I
know
don't
if
either.
you think it will.
I don't either.
What are your thoughts?
I think you're seeing more price sensitivity in some of these markets where during the pandemic people could live anywhere they wanted. I saw a headline over the past week about the housing market in Las Vegas is not too hot right now. The weather might be, the real estate market's not. Another place, as an example, is like Florida. You know, you got the cost of property insurance if you can even get it,
Yep.
and that's hurting affordability. And you see some inventory stacking up relative to recent history. So yeah, there's some areas that are showing some cracks, but for the most part, wow, it's been interesting, and I think it's just because they've printed so much dollars, and that's the byproduct of it.
Absolutely. I agree. So I think for investors, and we talk about this all the time on the podcast from a financial planning perspective. We're not telling you to wait. If you need to buy a house, you should buy a house. Use your budget and buy in that 30% range is a good range to think about.
If rates come down, refi.
And if rates come down, refi. But be aware, I would not sit around and wait for this to drop off because I don't see it. I don't see a resolution coming quickly outside of a black swan event. And waiting around for a black swan event, you could be waiting for 10, 15 years. I mean, that's why they're called black swan events, because
I
you
know
never know
we're
when they're going to come.
Yeah, and I know we're running close to time on the podcast. I know there's been other thoughts, Nick, in regards to how the real estate investment side has really changed with these prices, because rents, generally speaking, are not up 50% like home prices in the last
Yeah,
5 years. I know there's a delta, there's a difference on that, and it's making the return on investment in general not as attractive on real estate at these prices and what people
yep,
can get for rents. That's another topic for another day, but I know that's a challenge for people that used to do real estate investment. You're not getting the ROI that you think you can.
absolutely, particularly on the multifamily side. Yeah,
Yeah, that's another
yeah.
interesting topic.
So the last piece I have, and I'll just try to run through this quick, is a change at the Fed chair and what that means. There have been a plethora of headlines about Fed Chair Powell, poor guy, just getting beaten up in the headlines. He's just an economist. He's a normal guy. He's just getting crushed. Um, I feel for the guy, truly. A few things I want listeners to understand. The Fed acts independent of the White House. It's designed this way since its creation. Yes, the board of governors is nominated by the president and confirmed by the Senate, but they're in staggering terms. There's 7 of those, and there's a Fed chair and a vice chair. There's 7 board of governors, but they're elected in staggering terms. So it's not like the president can just turn over the whole board of governors and change everything. Even if that were somehow the case, I'm not even sure about the legality of firing Fed Chair Powell. I don't even think that's a thing. In an astronomical scenario where that did happen, let's say they put in a new Fed chair and Trump gets his guy. Friendly reminder that Powell was Trump's guy 8 years ago, but that's just showing you that every Fed chair in the history of time has always been beaten up by politics. It's literally what they do. So even if they replace Fed Chair Powell, it's going to go to he'll be the new Fed of the Board of Governors. The 12 reserve banks that are also in the room of the FOMC, the FOMC is the one that decides to change the interest rate policy. There are 12 voting members and 7 non-voting members that are in the room. So 7 of those are the Board of Governors, which again, nominated by the president, confirmed by the Senate at a staggering timeline. So again, it's not like you're going to be flipping these guys all the time. The term limits on the Board of Governors is 14 years, right? 14 years for the Board of Governors. And if someone leaves to go to another post, which does happen, and another governor gets nominated by the president and confirmed by the Senate, they're serving an unexpired term. You could get in on an unexpired term for 10 years. Then you can sit again for 14 years. You could be on the Board of Governors for 20 years, longer. So then you have the 12 Federal Reserve Bank heads, the heads of those banks. And that's really more of an internal process within the Fed. It's tertiarily affected by politics because of basically they have a search committee of Class B, Class C directors at specific Fed bank boards, and then those Fed banks have a committee, and then they go out and find hiring pools, and then they interview and they find good candidates, and then the candidate is subject to approval by the Board of Governors. That's all the political shenanigans that can go on. They just have to be confirmed by the Board of Governors. Right? As far as making the actual decision on the interest rates, again, there's those 19 people in a room, 7 Board of Governors, 12 Fed banks. There are 12 voting members, 7 board of Governors get a vote. The New York Fed Bank president always gets a vote. And then there are 4 other of the Fed Bank presidents that get a vote. And those 4 others rotate across those 11 remaining banks on a 1-year cycle. And it's predicted.
He's talking Richmond, St. Louis, Cleveland, etc.
Exactly. And if all of this stuff is mind-boggling, I encourage you to go to the FederalReserve.gov. Tons of great information. If you feel like you don't have a good handle on it and you want to understand it better, definitely check that out. So the votes are done to change interest rate policies by a simple majority.
Oh, very key
It is
for our
a
listeners
simple
and viewers to
majority.
hear.
There are 12 votes. 7 votes is a simple majority. And most
It's not
of the
unilateral,
time,
one person making the decision.
the Fed chair does not have veto power. It's not like it is a committee. He's just the guy who speaks on behalf of the committee, or gal, and Janet Yellen being the previous Fed, right? So the takeaway here is the prevailing assumption, I think sometimes, and the local media and things that I've seen, which really, as you can probably tell, kind of grinds my gears a little bit.
I know.
The prevailing assumption is that the next head of the FOMC will be able to easily lower rates in accordance with the president's wishes. That is not true. That's just not how it works. It's just not how it works. These organizations and these committees have been designed this way on purpose. They've been independent of politics on purpose. It's probably, this might be a hot take, but I think it's probably the best piece of our government that we have ever created.
I like that. I like that.
It's because it works. The rest of the world has built, they've mimicked our financial system.
They have.
There's a reason, because it works. And most of the shenanigans that have happened in the past, and I think about the housing crisis and things like that's not the Fed. That's just things happen, right? That had nothing to do with the Fed came in and fixed it.
Yeah.
Uh, um, so I think the Fed gets a bad rap in the media, and I get that people want the Fed to and Trump and people want rates lower sooner, but they have to look at the data. That's literally their job. And as long as the data continues to say that people are spending money and that people have jobs, then they can't cut rates, because if they cut rates, then what will happen is people have more money, and then they'll spend more money, and then they'll push up inflation. And then we'll see the same thing that we saw 4 or 5 summers ago when the price of lumber is up 120%. And everybody's like, this is the worst thing ever. How come everything is out of control and the prices of everything is horrible and this sucks. This is the worst. And it's like that's why they're not that's why they're not cutting rates.
I love this. You're spot on. This is nice. I'm going to call it
Yeah.
the Nick Whitaker TED Talk about the Fed.
This is something I do feel somewhat passionate about, because I just think there's a lot of misinformation. And then the president, the federal chairman, Powell or Yellen in the past, they'll have to go and appear before Congress, and basically discuss what's going on, what are they talking
Justify
about.
their decisions.
Right, because the board of governors is it's a federal committee, so they're basically subject to conversations essentially. And if you've ever watched those, it at times is comical, because most of the time the congressmen and women who are talking to Federal Chair Powell are just lobbing absolute idiotic questions towards the
Yes.
Fed chair. And
Yes.
they're using it as a soundbite
Yes.
for their campaign. That's
It's
it.
not about the answer. They just want to be on record asking that question.
Yeah. So and then these poor economists, these very smart people who've spent so much time understanding economics and the global financial system, and then they're sitting there just like, what did you ask?
Did you ask me?
This doesn't make any sense. So yeah, the Fed chair gets a bad rap. No one in the markets has ever loved the Fed chair, because they always want the Fed to move faster than they can. They can't. Data is slow. Data takes a long time. I get that you could try to, guess and be like, oh, the data is definitely going to be lower, so we'll go ahead and cut. But what if it's not?
Yeah.
And we've been wrong about data all the time, and we will continue to be wrong about data all the time. It will surprise us. So that's what's going on with the Fed. Please don't buy into any newsline hatred of Federal Chairman Powell. He's just doing his job.
That was well said.
He's just trying to do his job.
Well said. Before we wrap up, I got two hot takes on the Fed. The first is, I miss Janet Yellen's laugh. She had a laugh that was contagious, right? She starts laughing, everyone starts laughing.
Yeah.
My second
It's
thing,
because it was hard to make her laugh.
it was, but when she got going, she got going. The other thing is, this is going to date me, okay? But one of the things I enjoyed when I started in the industry in the late 90s was, at the time, it was Greenspan was our Fed chair. And the financial news media would attempt to predict monetary policy based upon the size of Greenspan's briefcase, the thickness of his briefcase walking to Fed decision days. They would then dissect the thicker it was, the more likely that there was going to be a policy change. Can you believe that?
I do believe that. And for listeners who don't know, you can go into the history of the Fed, and admittedly, I know the very recent history, but I wasn't in the markets during Greenspan's day. Uh, that's one of the things Ben Bernanke did, and Ben Bernanke was the Fed chair who kind of pushed us through the financial crisis. That's one of the things Ben Bernanke did was try to open up transparency with the
Yes, good
Fed
point.
and to try to have the Fed communicating to the street so that
Starting some sort
market
of
part-
guidance,
so that
right?
market participants didn't have to look at a guy's briefcase and try to
They were,
guess.
dude. I remember.
believe
I
it. Yeah,
remember
I
in the
believe it.
morning watching the financial news media and seeing this guy walk and seeing how thick his briefcase was. I know it sounds absurd,
I don't
but
think
we
it
did it.
does, just from what I've read about
We did it.
transparency and trying to change that. So I
Oh my
believe it.
gosh. Then see, now people are going to start running the math in their head to figure out my age. Here we go. All right. So, closing comments, Nick. You know, we're obviously about a solid week into Q2 earnings season. Any other thoughts, comments before we sign off? How's your
No,
golf game?
golf game is it's okay. It's not great. We're still pretty bad at golfing. If I'm being honest with myself, but it's fun. It's a good time.
Listeners and viewers, don't let him mislead you. Nick has this silky smooth swing. It is silk.
It's silk. It looks really nice, and it goes straight into the woods. Um, yeah. Aside from my very very poor golf game, yeah, all is well. I hope listeners enjoyed my Fed rant. That's I don't have many of those, so yeah,
I'm here
Q2
for
earnings
it.
hang in there.
I'm
I
here
think
for it. So now what I'm doing in the back of my mind is I'm gonna start gathering all the things that just really just grind Nick Whitaker's gears. And Jenna knows how I think. So you better believe I'm gonna be bringing this sucker back up at the next time you're with me. We'll see what the Fed does in July 30th. And then the Fed meets every 6 weeks. The one after that is September, mid-September.
yeah. If you ever want to poke the bear, just talk about how you think Congress does such a good job grilling the Fed chairman.
I love it. I love it. My wife has a really good friend who works, I think, at the Cleveland Fed. I'm going to see if I can work my resources, see if we can maybe get a guest on the podcast. I'm
That'll
not
be great.
sure what restrictions that type of role has
Yeah.
from a media standpoint, so that might not even be allowed. But I'm going to start working my angles given this, right? I'm
Yeah,
going to have
there.
her be like, hey, check out episode 310. And if you can be on a media outlet, come on to the Independent
Yeah.
Advisors podcast. We'll make you a guest. And then
I think-
guess who's going to be a part of me with that? You, buddy.
That's right. I think Cleveland has a vote next year too. I think so.
I like that. I like that hot take. I
have
like
to
that
double.
hot take.
I have to double check.
Well, the next time I think I'm going to get out there swinging a club, it's going to be a while. It's going to be like in 3 weeks. I don't play very often, so I'll report back.
Yeah.
But I said it on the last week's podcast. I'm coming off a pretty big high. I played 9 holes with a good friend of mine, client, and I did really well in 53 on, and that's complete legit. I had 2 drops. I'm still riding that, and that was weeks ago.
I get it. Yeah, 2 drops is great. I normally have 6 on the front, so.
Yeah. All right. Well, let's close it out. So thank you for listening to a long episode, 310 of the Independent Advisors Podcast. Lots of good content. Nick, thank you for being on with me. Thank you, Jenna, on the production side. We will be back next week, 311.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.